with no sells on Wall Street for Nvidia and 48 buy or overweight ratings. Most are bullish on the chipmaker, including our next guest, who has an outperform rating and $150 share price target, Chris Caso, Wolfe Research Managing Director and Senior Analyst. Chris, welcome. Good to have you with us.
Thank you.
Seema mentioned the issue in the report today, and that is the launch of Blackwell and whatever the company says about that, Blackwell being a next-generation chip. What do you expect here? What would be good news? What would be less good news?
Well, Nvidia typically doesn't give very granular detail on the earnings report. What they've said in the past is Blackwell starts to ship in the second half of this year. And the most important flavor of Blackwell, if you will, is what they call the GB200, which is the most powerful version that's going to go to hyperscalers in the beginning of next year. There's been, all sorts of discussion, rumors within the supply chain of that being potentially delayed. But our view on that is, these are very complex product ramps. They're coming out with new products every year. We've kind of, talked about that a little bit of the sausage making of semiconductors, where not everything goes absolutely flawlessly. But Nvidia guided for that product to be out in the first quarter of the year. And we still think it's on track for that. And we expect Nvidia to, basically reiterate what they've said before with respect to that.
Let me ask you a question that's a little more sort of philosophical than anything else. Does Nvidia have a lead or a moat, or does it have both?
I think it has both. And, certainly they've established a lead within, overall AI. Where their biggest moat is actually one in software, where especially for training models, most of the models are trained using basically proprietary NVIDIA software. And then on top of that, the networking part of the business, which NVIDIA got in part by their acquisition of Mellanox many years ago, also provides a competitive moat because networking is now becoming a much bigger driver of performance within AI. And NVIDIA is the only company that has that in-house.
But even with NVIDIA's leadership, Chris, we're expecting, yes, a big jump in revenue and earnings, but we're expecting gross margins to decelerate. Why do you think that is? And is that because of expenses attached to Blackwell? Well,
it's really a function of mix and with Blackwell coming out and some of the costs associated with the launch of that new product. But, at this point, I think if people see a good revenue number, if they see, good progress on Blackwell into next year, that's what's really important for the stock. And the important thing is Blackwell, we believe, drives as much as a 50% year-on-year content gain next year. And NVIDIA's business model has been, we charge more for the product because the product costs more, but we give you multiples of that in terms of performance. And so it's a little bit of a win-win. The customers get much better performance and NVIDIA is getting higher revenue. And, that's what's been exciting about this stock. And that is what played out over the last, year and a half, 2 years or so, where, the biggest driver of NVIDIA revenue has been the content per chip going up.